Happy Friday! Time to learn a little bit. I'm going to talk to you about temporary interest rate buy downs. So, I know we've talked about this a little bit. You've got some emails from me, some text messages, some smoke signals, but still some confusion about it. So I wanted to figure out a way to show you visually what this looks like. So this is a 30-year fixed loan. I've had a lot of questions about that. Is this an adjustable rate mortgage? It is not. It is a 30-year fixed. I'm running a scenario right here. It's a $750,000 loan, $600,000 loan amount, be 20% down. Now you don't have to put 20% down. This could be a VA loan with 0% down. It could be an FHA loan, 3.5% down. Could be 10% down, 5% down, 3% down conventional. Doesn't really matter. As long as it qualifies for one of those programs, it would qualify for this, potentially. So most people will. Call me if you have any questions about that. But the way it works is instead of permanently buying down the interest rate, spending an exorbitant amount of money that you're probably not going to recoup in fees when interest rates come down. That's what I've been telling people. Don't pay a bunch of money in points to buy the interest rate down when you're probably going to be able to get that rate for free, maybe about a year from now. We're expecting rates to come down somewhere in the 4.5% to 5.25% range sometime next summer. So don't pay today what you can get for free later on. But I know we do want to have a lower monthly payment now, and this gives you the ability to do that. So the way it works, a 3-2-1 buy down. There's a 3-2-1 buy down, a 2-1 buy down, and a 1-1 buy down, or however you want to call it. It subsidizes your payment to an effective interest rate 3% lower in the first year for the 3% down, the 3 buy down. The 2-year buy down will be 2 years, 2% down for the first year, 1% the next year. So let's say you did a 3-year buy down. First year, 4.25%. This is again based off 7.25%. The first year effective payment would be based off the effective interest rate of 4.25. Next year, 5.25. The year after that, 6.25. And then years 4 through 30, 7.25. If we are still at this interest rate in 4 years from now, we haven't had a chance to refinance. That means some things are going pretty wrong in the economy, so we probably have bigger problems. But as long as you can afford this payment, even if it's a little uncomfortable to begin with, I tell people you're only going to get better. So the way it works, on a 3-2-1 buy down, in this scenario, it would cost $27,840. Now, is that a fee? No, it's not. That money is going to be set aside in that escrow account we talked about. It's going to go into a little money bag here, and every single month, this is going to subsidize your payment for the first year by $1,141 a month. If we get into the second year, don't have a chance to refinance, it would subsidize your payment every single month by $779. Now, let's say we did get a chance to refinance a year from now. Rates do come down like they're expected. I know Fannie Mae just recently came out with their projections of 4.5% next summer, or at some point next year. But if after the first year you refinance, you still have $14,143 left in this account. What happens to that? What happens to that is it's your money, so you get to keep it. And what happens when you refinance is we're going to basically just take that right off the top, reduce your principal balance by that amount, so that money's not gone. So if you spent this on buying points today, like a permanent interest rate buy down, or this amount in points, then you're crazy. This amount might make sense to some people, but you're not going to get that money back. And it's probably going to make you reluctant to refinance in the future if you know you're not going to recoup the fees you spent up front. So this gives somebody an option where they could pay basically 4.25%. Who's paying for this? Technically, you could pay for it. You could do this yourself. Now, this happens automatically. So the beauty of it is you don't have to mess with it. You don't have to do anything. Your payment will be, your principal and interest payment for the first year will just be this. And then the next year will be this, and so on. But ideally, we would want the seller to pay for this. Don't get mad at me if you're a seller right now, but a lot of people are making pricing cuts. So instead of cutting your price by $30,000, offer this. I mean, how many people are reluctant to buy your property because rates are high? Now, if rates were 4.25, they wouldn't be complaining about rate right now. I mean, people are always going to complain, but last year we had people like, I'm waiting for the housing market crash. Well, that's not coming to the extent that anybody thinks it is. Those people, this is the time. So right now you're getting the ability to get a deal or to buy a house at what it's worth this is the time to do that. Now rates are higher, but when rates come down, who's going to come back into the market? Everybody. Everybody's going to get back in the market. You're going to see a lot more competition. You're going to see house prices get driven up again, just like they were. So right now, get into the house while you can get something like this. Definitely this. I mean, this could be a little bit difficult, and we can talk about that and some of the potential pitfalls, mainly having to do with possibly a low appraisal. But this, we shouldn't have any kind of problem with. We're doing this all the time. So get into the house right now while you can get a concession, while you can buy a house, not at a premium. We'll fix the rate later. When we say in this business, marry the house, date the rate, that's what you're doing. You're dating the rate for a first year, 2 years, 3 years. But ideally, you're going to be in this rate for 12 months, maybe less. And we'll be at, let's say, 4.5%. Everybody's going to be happy. You're going to have a house, and you didn't pay a bunch in fees that you're not going to recoup. So anyway, if there's any more questions, give me a call. Happy to walk through this with you.